In 2006, the largest banks in the United States publicly stated that the financial system was solid and secure. Official reports repeatedly stated that risk was under control and that the housing market was one of the most stable pillars of the economy. However, in that same year, internal documents from some institutions already showed an accelerated growth in defaults and clear warnings about loans that would be difficult to repay. This contradiction is the starting point of the 2008 crisis. If the data was available, if the signs existed, and if the risk was already appearing in the numbers, why was nothing stopped? Why did credit continue to grow? Why did the system continue in exactly the same direction until it collapsed? The 2008 crisis didn't begin when the banks collapsed. It began when conscious decisions were made despite warnings. To understand what really happened, it's necessary to investigate not only financial institutions, but also the behavior of ordinary people who began to act differently and were encouraged to do so. Buying a house ceased to be merely a housing decision. For millions of Americans in the early 2000s, it became a financial strategy. The dominant idea was simple, repeated, and widely accepted. Real estate always appreciates in the long term. Even when there were occasional drops in some regions, it was believed that prices would never fall across the country. This belief didn't arise from nowhere. It was built up over decades and seemed confirmed by the historical data available at the time. What made this idea spread so quickly was the specific context of that period. After the bursting of the internet bubble, interest rates were kept very low for several years, and credit became abundant. Financing a property had never been so easy. With cheap money and easy access to credit, people who previously would only buy one house started buying two, then three. In many cases, these were not large investors or specialized companies, but ordinary families who sought in the real estate market a concrete opportunity to supplement income and build wealth. This model seemed to work. A person would buy a financed property, rent it out, and use the rental income to pay the mortgage. The property's appreciation would do the rest. Over time, the increase in the value of the first house would serve as collateral for the purchase of the next. This cycle repeated itself, fueled by the belief that there would always be a buyer willing to pay more in the future. It was an extremely seductive idea. After all, who wouldn't want to get rich in this seemingly simple and safe way? This behavior was especially concentrated in cities like Las Vegas, Phoenix, Miami, and several regions of California, where prices were rising faster than the national average. In some of these markets, a significant portion of the purchases were not made by people intending to live in the properties, but by individual investors betting exclusively on the continued rise in prices. The problem is that this demand didn't stem from real income growth or a genuine housing need. It came from the expectation of appreciation. The higher prices rose, the more people wanted to enter the market, and the more people entered, the higher prices rose. The system began to feed on itself, creating the appearance of healthy growth that, in practice, was fragile. This is the first clear sign that something was wrong. A sustainable real estate market grows based on income, need, and ability to pay. The American market, at that time, grew primarily based on expectations and excessive confidence. But this behavior was only possible because there was a second essential element supporting it all. Someone was willing to finance, and that's exactly where the investigation needs to go. If so many people were buying houses they couldn't afford on their own, who was providing the credit to sustain this growth? For this behavior to spread nationwide, something more than optimism was needed. The credit was required. And, in the early 2000s, credit not only existed, it was abundant, cheap, and increasingly easy to obtain. After the collapse of the dot-com bubble, the Federal Reserve kept interest rates at historically low levels for several years, aiming to stimulate the economy. The side effect was a market flooded with money, searching for a destination. Banks began to compete aggressively for new customers. Granting loans ceased to be a cautious process and became a volume-based operation. The more loans made, the better. Requirements decreased. Income verification became superficial and, in many cases, practically non-existent. People who would never have been approved for a mortgage before began to receive prepackaged offers with seemingly advantageous conditions. These contracts were sold as affordable and secure, but they hid significant pitfalls. Many mortgages had low interest rates only in the first few years. After that, the installments automatically increased. The implicit expectation was that the buyer would refinance before the adjustment, using the property's appreciation as collateral. In other words, future payments depended on a single factor: house prices continuing to rise. This detail was rarely emphasized. For many buyers, the feeling was that financing was just an intermediate step, something temporary until the property was worth more. The risks seemed distant, almost theoretical. While prices rose, no one felt the real weight of the debt. Most importantly, This model wasn't limited to isolated cases. It became the standard. Banks created increasingly flexible products to meet growing demand, and the logic of prudence was replaced by a logic of speed. Approving loans quickly became more important than assessing whether they would be repaid in the long term. But here, a central question arises for the research. If these loans were clearly risky, if many buyers did not have sufficient income to support them under normal conditions, why did the banks continue to grant credit in ever-increasing volumes? The answer lies not only in the sale of real estate, it lies in what happened after the loan was signed, and that is precisely where the investigation needs to advance. If the banks weren't concerned with receiving that money over decades, where did those debts actually go after they were created? When a mortgage was approved, the bank didn't necessarily plan to receive that money over 30 years. In practice, the loan rarely remained where it originated. Shortly after being signed, it was sold. The bank packaged hundreds, sometimes thousands, of similar mortgages and transformed them into a financial product that could be traded on the market. The debt of an average family ceased to be a long-term commitment and became part of a much larger machine. These mortgage packages were presented as predictable investments capable of generating regular and stable payments. For buyers, the promise was simple. Instead of depending on a single borrower, the investor would receive small installments from thousands of different people. In theory, this would dilute the risk. In practice, all those payments depended on the same central factor, the continued ability of families to pay their mortgages, sustained by the appreciation of the properties. The crucial point is that this risk didn't disappear. It simply changed form. Instead of being concentrated in a local bank, it spread across investment funds, insurance companies, international banks, and pension funds around the world. Many of these institutions didn't analyze the individual loans behind these products. They relied on something that, at that moment, seemed sufficient: risk ratings. Specialized agencies evaluated these packages and assigned ratings indicating the degree of security of the investment. Many of these products received the highest possible rating. This created a sense of legitimacy. If an asset had the highest rating, it could be purchased even by extremely conservative institutions. The seal of security opened doors and eliminated questions. But there was a structural problem that few were willing to confront. The ratings were based on models that assumed the housing market wouldn't fall synchronously across the country. This premise had never been tested on a large scale. Yet, it was accepted as truth. The risk was treated as something statistically improbable, almost irrelevant. Within financial institutions, this system created dangerous incentives. Those who originated the loans earned by volume, not quality. Those who packaged and sold the products earned at the moment of the transaction, and those who bought trusted that someone, somewhere, had done the correct analysis. The responsibility was diluted as risk spread. Some warning signs began to emerge. Small increases in defaults, internal reports pointing to weaknesses, discrete adjustments to the models. But these signs rarely reached the public. And when they did, they were treated as temporary noise in a system that seemed too solid to fail. The machine kept turning because stopping would mean questioning the entire model. It would mean admitting that the security sold up to that point might just be an illusion. As long as property prices continued to rise, no one had a real incentive to pull the brakes. But the risk was there, silently accumulating, and when the foundation of that system began to crumble, the speed of the fall surprised even those who thought they understood what was happening. If the risk was spread throughout the entire system, who would be the first to feel the impact when something went wrong? As the risk silently spread through the system, not everyone remained blind. Far from the optimistic public pronouncements and reassuring reports, some professionals began to notice that something didn't add up. They weren't necessarily activists or outside critics, but people who worked within the financial market itself and had direct access to the raw numbers. They observed a steady increase in defaults, especially among the most recent loans, and realized that this didn't align with the official narrative of stability. In some banks, more cautious managers began to discreetly reduce their exposure to the real estate market. They didn't make announcements, they didn't raise public alarms, they simply changed their position. In investment funds, certain analysts began to question the real quality of the assets that were being bought as safe havens. They realized that many of those products depended on the same fragile assumptions and that small drops in property prices could cause much greater losses than the models indicated. These warnings, however, rarely rose through the ranks. Questioning the model meant questioning immediate profits, bonuses, and career advancement. In an environment where almost everyone was making money while prices rose, caution seemed like excessive pessimism. Many who recognized the risk too early were ignored, isolated, or simply replaced by professionals more willing to move forward. At the same time, some investors adopted a defensive stance. They reduced leverage, accumulated cash, and began to observe the market with increasing distrust. These movements didn't make headlines, but they left traces. When large institutions begin to protect themselves quietly, it usually indicates that internal confidence is no longer the same as that displayed to the public. The clearest sign that fear was spreading came when financial institutions began seeking help outside the traditional circuit. In times of stability, banks turned to other banks. In times of crisis, they turned to those with liquidity and reputation. It was in this context that names like Warren Buffett began to be sought after. Not as saviors, but as a last line of defense. These conversations don't happen when everything is going well. They happen when the system is already under strain, even if that's not yet visible to the public. The fact that large institutions were seeking private capital under unfavorable conditions indicated that trust among the banks themselves was rapidly deteriorating. Not everyone remained convinced. Within the system itself, some began to realize that the numbers did not confirm the public discourse. Default rates were rising precisely in the most recent loans, and this indicated a structural problem. In response, some institutions began to discreetly protect themselves. They reduced exposure, decreased leverage, and accumulated cash, without announcing anything publicly. Questioning the model meant questioning immediate profits. Many warnings were ignored or delayed. This pattern was not new. It had already appeared in other crises. The clearest sign that fear was spreading came when institutions began seeking help outside the traditional banking system. It was in this context that the name of Warren Buffett started to appear. He wasn't sought out because everything was fine. He was sought out because trust among the banks themselves was already deteriorating. Buffett imposed very tough conditions: high returns, special guarantees, protection against losses. His entry didn't signal optimism, but extreme stress. If some were already protecting themselves and seeking help, what would happen when the entire market perceived the same problem at the same time? Despite this, externally, the message remained the same. The system was solid. The problems were localized. The real estate market was resilient. The gap between what was said publicly and what was being done internally widened each month. When that distance becomes too great, history shows that the adjustment is usually abrupt. And, at that point, the question was no longer whether something would break. Idwasrananano would be the first. If some were already protecting themselves and seeking help, what would happen when the entire market realized the same problem at the same time? The first public sign that the system was collapsing didn't come from a grand announcement, but from a series of small disruptions. Banks began to hesitate before lending money to each other. Lines of credit that had always been available were reviewed, shortened, or simply canceled. What once worked automatically began to require extra guarantees, emergency meetings, and approvals that were never granted on time. Trust, the invisible element that underpinned the entire system, began to disappear. As this distrust spread, financial institutions realized they were sitting on assets whose true value no one could determine. Products that had been sold as insurance no longer found buyers. Without a market, there was no price. Without a price, there was no certainty about the health of balance sheets. Each bank began to distrust the other, fearing that any transaction could transfer hidden losses. The interbank market practically froze. In March 2008, a large institution needed urgent bailouts to avoid a domino effect. The message was clear to those paying attention. The system was incapable of absorbing shocks without external intervention. Even so, the authorities tried to treat the episode as an isolated case, a one-off problem in a market that, according to official discourse, remained healthy. This narrative became impossible to sustain a few months later. In September 2008, the collapse of Lehman Brothers marked the moment when systemic risk ceased to be a hypothesis and became a reality. For the first time, a major financial institution was left to its own devices. The impact was immediate and global. Markets plummeted, credit evaporated, and companies in all sectors faced difficulties financing basic operations. The collapse was not limited to the financial sector. Production chains were disrupted, international trade slowed, and millions of jobs were put at risk. Solid companies, with no direct link to the real estate market, suffered simply because money stopped circulating. The highly interconnected system showed how dependent it was on a constant flow of credit. At that moment, it became clear that the problem wasn't just the failure of a specific institution. The problem was structural. The risk that had been packaged, diluted, and redistributed was now returning in a concentrated form, affecting everyone at once. What had previously seemed distant and technical had transformed into real panic. With the system on the verge of complete collapse, authorities faced a choice that would define the course of the crisis. Let the market adjust on its own, with unpredictable consequences, or intervene in an unprecedented way to prevent a total collapse. This decision would change everything. When the entire system is at risk of collapsing, who should be saved first and who is left to foot the bill? When the financial system reached the brink of total paralysis, the discussion ceased to be theoretical. It was no longer about the market, efficiency, or correcting excesses. It was about survival. Authorities began to work with an extreme scenario. If the major banks collapsed simultaneously, basic payments could be interrupted. Companies would be unable to pay employees, and the real economy would collapse in a matter of days. Faced with this, the option of not intervening ceased to be considered viable. Governments decided to act. Institutions deemed too big to fail received direct support, public guarantees, and immediate access to liquidity. Problem assets were absorbed, lines of credit were opened, and the financial system was artificially supported to prevent a complete collapse. The logic was clear. Allowing a chain reaction of bankruptcies would have even greater social costs. The goal was not to save banks on merit, but to prevent the collapse from spreading irreversibly. Meanwhile, outside the decision-making centers, the reality was quite different. Millions of families lost their homes, as foreclosures multiplied. Unemployment rose rapidly, and the sense of financial security vanished for a huge portion of the population. People who had followed the rules, trusted the system, and made decisions that seemed reasonable saw their wealth evaporate in a matter of months. The contrast became impossible to ignore. While large institutions were bailed out to preserve the system's stability, individuals bore the consequences alone. Few high-ranking financial executives were held criminally responsible. In many cases, those who had taken excessive risks retained positions of power or walked away with significant compensation. For much of society, this solidified the perception that losses had been socialized while gains remained private. Over time, the system began to stabilize. Markets recovered before the real economy. Banks returned to profitability, while many families took years to recover if they ever did. The financial system that emerged from the crisis was neither smaller nor simpler. In many respects, it was more concentrated and more dependent on public intervention than before. This is where the investigation concludes. The 2008 crisis was not an unpredictable accident, nor the result of a single isolated error. It was the consequence of choices made over years, based on clear incentives, fragile assumptions, and excessive confidence in a system that seemed too safe to fail. When the promise of security broke, the cost was distributed unevenly. The question that remains is not just what happened in 2008. The question is, how much of that system of the same structures, the same incentives, and the same beliefs still exists today? Because, in financial history, crises rarely repeat themselves in the same way, but they almost always begin the same way.